Okay, hello and welcome everyone. It is a minute or so after 6, and so I will honor the people that are on time and get started on time, and we have 306 slides tonight. And I'm not joking. So, welcome. We shall see how this goes. Yeah, that's crazy. All right, so we do have a podcast. If this is your first class, welcome for coming, first of all. Second of all, this is a crazy first class to come to, unfortunately. It's going to be a ton of information, but you guys are going to be drinking from a fire hose because there's a lot of stuff to go through. There's no joke. There are 306 slides. However, I probably will be breaking this up into at least 2 different nights. So I'm going to take my time and go as slow as I need to make sure everyone gets it. But this probably will not get through the whole class tonight, so there'll probably be a part 1, part 2. When I was doing the class today, I was writing it this morning, all day actually, and I told Tammy this is probably a full day seminar. There's that much stuff to it. So we may actually expand on it and break it up into subsections and stuff like that, but we'll do that. So if this is your first class, don't be overwhelmed. There's a ton of really good, first class where you should have come to that class stuff on the podcast. For example, there's a really good one on how to get your first deal done. It's the class where Brian tries to teach 300 classes in one night. But he goes over everything from the very beginning through renting properties out. And it's a really, really good overview. So I would probably start off with that one if you're going to go through it. But they're available on the podcast and also on the website. So.
And in fairness, we then teach all the classes that are in the 300.
Yeah, we teach all the detailed stuff. The joke is Brian had a single bullet point on the class of how to get your first deal done, and the next night I was teaching a 2-hour class on that one bullet point. So we really go into detail and everything, but that's a really good overview class to get a good idea. And then probably the financing one is probably your next best one to start with. So those are probably the 2 that I jumped to first. So that's podcast. Any questions on podcast? Awesome. So just one more rental property. That's the topic for tonight. So, as I said, this is likely at least 2 full classes, so I'm going to take my time, go slow. I'm going to answer any questions you have, and we'll just continue off wherever we end up tonight at the 2-hour point. We'll take a break there, and then I'll do part 2 the next whenever we have another opening spot. So really what we're going to do is what difference does it make to get an extra rental property in a whole bunch of different scenarios, and what difference does it make in a whole bunch of different kind of property characteristics, like more rent, higher price, above asking price, or below asking price discount. And so what we're going to do is we're going to start off, and I'm going to go through a scenario where you start off with 0 properties. And I'll walk you through what retirement looks like, what your net worth looks like. There's no cash flow because there's no rentals, but we'll walk through a bunch of different things related to that. And then I'm going to add a single rental property to that, actually a single owner occupant property to that. And then I'm going to add rental properties on top. So we'll start off with no properties. Then we're going to do one nomad owner-occupant property. We'll put 5% down to owner-occupied, and I'll show you what that looks like. And then from there, I will then add on one additional nomad property as a rental and one 20% down property as a rental. And we'll do kind of a divergence of paths to show you the difference. Do you have a question?
Well, I had
Mike.
Maybe you should probably explain nomad too.
Yeah, I'm going to go over what nomad is. Awesome. No, the question was make sure we explain nomad, and we definitely will go over what nomad is. So that's what that's going to be. And then we're going to compare the 2 different scenarios, doing nomad versus doing 20% down, and what the difference is between those 2, because some people don't know the difference. So we're going to go into that in detail. And then we're going to jump basically and do up to 10 rentals. So I'll show you how to do nomad 11 times and what that looks like. And then I'll show you how to acquire 10, 20% down rental properties over a period of time and what that looks like. And we'll be able to compare those as well. And then we're going to compare each with 10 rentals, head-to-head, to see how they compare to each other. And then I'll do the variations, $50 more in rent, $50 less in rent. So we'll do those 2 scenarios with basically all these cases. And then buying properties with $10,000 discount and a $10,000 premium, and I'll show you the differences between all those and how much difference that makes. And so this is why it's a full-day seminar. So there's a lot going on here. So what we're going to do is we're going to do how it impacts net worth. We're going to do how it impacts cash flow. We're also going to do how it impacts your speed of acquisition, how quickly you can acquire properties, and making some basic assumptions about how much you earn and how much you're saving and how much you're earning in the stock market. And then we're going to do time to financial independence, basically when you could retire and live off of your assets. So I'll show you the first time you get to that point. And then we'll talk about risk, which is going to be a new factor. I added some additional charts that measure risk of portfolios. So now we're going to start, as we start doing additional classes, and Brian teaches some and I teach some, we'll start looking at how risky certain strategies are compared to each other. and this is going to be a new thing. So I'll show you some of those slides, and we'll go over that tonight. And then a bunch of other stuff. So any questions on kind of where we're headed tonight and in the next class or next two classes? Because it really might be 6 hours for all I know. There really are 306 slides. But we don't have to get through all of them tonight. This is the good news. Any questions on that? And I'm going to go slow to make sure you guys understand it, because if you don't understand the early on stuff, you're not going to understand the more complicated slides. So some of the slides have like a single line on them, and I'm going to show you how things are happening. But if you don't understand that chart, please pause me and ask questions, because if I start adding 6 other properties to that, you're really going to be lost. Does that make sense to everybody? Okay. Yes, question. Microphone.
Okay, so it seems like the slides are so important. Is this visually somewhere where we're going to be able to see the slides?
Yeah, so I record the video, the PowerPoint slides, and the audio at the same time, and they're available on the website. So yes, they're there. And I probably can make, I just don't want to do the extra work, but I probably can make all of the scenarios available so you could copy them to your own account on the Real Estate Financial Planner software and then change the assumptions. So tonight, for example, we're going to be going over someone earning $5,000 a month in income and saving $1,000 a month, so they're going to save 20% of their income. But let's say you make $4,000 and you're only saving $300 a month. You should be able to copy the exact scenario I have in here to your own account and then modify the income to be able to say, how does this change impact me? If I make $7,000 a month and I'm saving $1,200, does that make it faster? How much faster? What does it do? And so that's why you can go ahead and use the software to make those changes. And there was a class we did, I don't know, how many, was it a month ago or so, where we did the demo of the software? When was that, about a month ago? Yeah, so there's a video on that, but it's just Real Estate Financial Planner. Just go create an account, and I'll try to make the links available to you as well. But yeah, the slides are available too. Any questions? All right, awesome. Let's get started. So, I like charts. That's a quote by me. And this is literally the understatement of the night once you see how many charts there are tonight. Okay? So brace yourself. I hope you guys like charts too, because it's going to get crazy. All right, no property. So we're going to start off first. And basically, this is a chart of gross paychecks that someone is receiving. They're going to be earning $5,000 a month. Their paycheck is increasing with inflation. Inflation rate is 3%. So over time, this is basically month 0, all the way up to 720 months in the future, or 60 years. So that basically allows you to, the young guys in the room, allows you to model your FIRE stuff. But basically, at this point, you basically earn your income, and then at some point, you're able to achieve your financial independence, and you can retire early, and your paycheck goes to 0. So it looks like you're making a lot more money, but really what's happening? What's happening with inflation? Is this $5,000, are you really earning $20,000 a month toward your retirement? No, what's happening? With inflation, you're actually earning about the same. And so that's what this chart shows. If we adjust for inflation, you're making $5,000 a month, and at the end of it, you're making $5,000 a month. So this is before, this is with inflation, and this is after we adjust for inflation. It's the same dollar amount. Does everyone follow along? Because there's going to be a lot of charts tonight where I show you inflated dollars, future dollars, and I'm also going to show you what it looks like in today's dollars. So simple stuff, but I want to make sure everyone gets it. Is there anyone who's lost at this point? Sweet. Okay. All right, so how much are you saving from your paycheck? So in this case, we're assuming that this person, whoever it is saving $1,000 a month, and because of inflation, their savings are increasing a little bit each month until they get to the point where they hit their financial independence and they retire, they stop working, and then the amount that they're saving becomes negative because they're pulling from their investments. They're no longer adding money to their account, they're pulling it out. And then their expenses in retirement continue to increase, and it gets more and more negative over time. Does everyone follow along on this chart? So this is how much someone is saving from their paychecks. Now, if I adjust for inflation, what do you expect this to look like? What do you think? Call it out. It's going to go negative, so you think it's going to turn this way? So what we're trying to do is we're trying to model it so that it's the same. So in this case, they're saving $1,000, and we're going to try to maintain the same $1,000 savings rate over their entire working career. And then when they retire, it goes negative. But their standard of living in retirement is fixed. So we're assuming that we're living at the same standard of living. It's not increasing. Okay? That's why this is flat too. Your expenses in retirement are about the same. Does that make sense? Okay, cool. All right, so this is how much they have in the bank account. Since they don't have any properties, they're saving money, they're sticking in the stock market. I think I assume 6% for the stock market, so it's very conservative. And so they start off, I think we start off with $5,000 in savings. We're adding money to the stock market, about $1,000 a month, and it's growing at 6% per year. And so over time, this continues to grow. What happens at this inflection point? I already gave you a hint before. What happens? Why does this change the curve? We're retiring. And so now you're not actually adding money and saving more and earning on that. Now you're starting to pull some money out. And so this actually goes down. It's no longer at the same slope it was before. Now, this is in inflated dollars. So in their bank account, by the time they hit their retirement, it's just over, I don't know, $4.5 million or so. Okay? Now, what happens when we adjust for inflation? Super interesting. It's really only like 1.2 million or so is how much they have in order to have in today's dollars for retirement. And then we set it up so that it's basically flat. We tell them you are retiring, and at retirement you're pulling out basically how much you're earning in the stock market plus inflation. Okay? Does that make sense to everybody? Anyone lost? This is the simple part. So if you're lost here, it's problematic. Okay, everyone good? All right. So net worth. Since net worth in this case, they don't own any properties, their bank account balance basically is their net worth. So the curve looks identical. If I adjust for inflation, same curve as before. Everyone follow along? Okay. Goals. So this tells you what percentage toward your target monthly income in retirement you are at. And the way that we calculate this is it's made up of two components, and it's important for you to understand these two components. Component number one is we have a safe withdrawal rate of the amount you have saved in the stock market. So we assume you could take out a certain amount of money from the stock market each month so that you can live on it. And we assumed in this case it's 4% based on the Trinity study. Now, if you came to the other class, you'll know that I think that's optimistic and that you probably should use a slightly lower number. But for tonight, we're using 4% for our safe withdrawal rate. So what percentage we are toward our goal is made up of our safe withdrawal rate times whatever we have invested. In this case, it's 4% of whatever we have invested, plus, anyone else want to guess? Plus what? Plus cash flow from any rental properties we have. So we have two sources of income in retirement. Our safe withdrawal rate, any money we have in the stock market, plus any positive cash flow we have from any rental properties we have. We combine those together and they contribute toward how close we are to achieving our goal of being financially independent. Once you get to the point where your investments can support 100% of your target monthly income in retirement, then you are technically financially independent and you can live off your investments at that point. Does that make sense to everybody? And so in this chart, we show you that over time, just from the stock market, your stock market's growing and the safe withdrawal rate from the stock market eventually gets to the point where it can support you all the way out here in year, whatever this is, 550 or so. At that point, you stop working and you're living off of your investments where it basically stays just at this line. It does not continue to increase your standard of living. So you just have enough at that point for equilibrium. You have enough coming in from the stock market just to support you, no more. Does everyone follow? All right, cool. Whoops. All right, now what we're going to do is we're going to add Nomad. So how many people, this is your first class again? Raise your hands. Do you guys know what Nomad is? Awesome. So what Nomad is sequentially buying houses. You buy a house as an owner-occupant. You move in. You live there for at least a year. The requirement to live there for at least a year is a requirement of the lender. The loan you get basically says you need to stay in that house for at least a year. At the end of the year, or 2 years, or whenever else you want to do it, but it has to be at least a year, at the end of that period, you can go buy your next house, again as an owner-occupant. You put 5% down or whatever you do, but you keep the previous property and you convert that one to a rental. So by doing this, you're able to buy a property with little or nothing down, 5% down in this case. You buy the property as an owner-occupant, you move into the property, you live there for a year in order to meet the requirements of the lender, and then at the end of the year, you buy another house, you convert the previous one to a rental, and now you have another property you lived in as an owner-occupant, and the last one you lived in as an owner-occupant before as a rental. Does that make sense? If you repeat this as many times as you want until you acquire the number of rental properties that you desire. So you could do this 10 times or 11 times or 20 times and continue to move into new properties, converting the previous one to a rental until you acquire as many rentals as you want. There's no limit except your ability to qualify for the loans, but you have rental income to help you qualify for those. Does that make sense? Any questions on that? Because it's a really key concept tonight that we're going to continue to use. Everyone's good? I going too slow? Brian says yes, going too slow. Okay, so I've introduced a new chart. This one basically shows you how many properties you own. So this is 0. So you're saving up money for several months before you're able to have enough money for a 5% down payment plus 2.5% in closing costs in order to do this owner-occupied property and move in and live there. At that point, your number of properties you own goes from 0 to 1, and then it stays at 1 for the rest of the time because you just buy one property in this scenario. Does anyone know why my closing costs are 2.5%? Because that seems really high to me when I say it out loud. Does anyone know why my closing costs are 2.5%? What's that? I didn't buy down the interest. In this particular case, it's because I prepaid PMI. PMI is private mortgage insurance. So if you're going to put less than 20% down on a property to buy, the lender is going to want you to pay a third party, an insurance company, to insure them, the lender themselves, against loss. So here's how this works. You pay a third party company, a private mortgage insurance company, a premium. And basically, if you actually get foreclosed on and the lender ends up losing money, the third party insurance company will pay the lender to cover part of their loss. So in order to protect the lender, they are requiring you pay private mortgage insurance in order to do that. There are 3 ways to pay private mortgage insurance. One way is to pay one-time upfront premium, and that's what we opted to do in this scenario. Another way to do it is to pay monthly. And the third way to do it is to have the lender increase your interest rate and give you a credit to cover the upfront payment. Those are the 3 ways to pay PMI. In this particular case, we paid a single upfront PMI payment as part of our closing. Now we don't have any monthly payment part of that. Does that make sense? Okay. So in this case, we saved our money. We're saving $1,000 a month, and it took us a little while, I don't know, whatever this is, 25 months or so, in order to have enough money for the 5% down payment, plus 5% in cash reserves, plus 2.5% in closing costs, and then that actually said we bought the property and we own one property for the rest of the time. Okay. So let's talk about personal expenses. So if you remember before, I showed you the personal expenses. Well, actually, I don't know if I showed you personal expenses, so I'll show it to you here. So basically, our personal expenses here were basically $2,800 or so, and this is while we were renting. So we're renting a property. By the time we go and buy a property, it's actually more expensive for us to buy the property, the monthly payments on it, principal, interest, taxes, insurance, than it was for us to pay rent. So we stopped paying rent. We now have this principal, interest, taxes, and insurance on the property itself, and that bumps up what our expenses are. And then our expenses continue to grow over time until this point when it drops off. What happens here? Why do our expenses drop off? I'll give you a hint. 30 years after we buy the house. We paid off the house. So at this point, we no longer have a house payment. The house is paid off, and so our expenses drop way down. And now our expenses are without housing payment. We're no longer paying principal and interest. We still have taxes and insurance, but our principal and interest part of our payment is gone, and that continues to increase through retirement. So this is our expenses. A little bit more expensive when we buy the house, but it goes away, principal and interest part, 30 years later. Everyone follow? Okay. Now, this is the same red thing I just showed you, our expenses for this. The orange line now is the expenses from we had before when we did not buy a house. So we just basically were paying rent, and we had all of our other expenses going up with inflation over time, and those just continue to increase. So what's interesting to me is, when you buy a house, if you zoom in really close here, because you guys can see in the back of the room really, really well, your expenses when you buy the house at first are more than if you're renting. You voluntarily take on a short-term increase in your monthly expenses. It's dipping into your savings. You're no longer able to save the full $1,000 because you're actually paying a little bit more in your mortgage, your principal, interest, taxes, and insurance on the property, and so it's a little bit more expensive than renting. But after a little while, what happens? Eventually, rents are going to go up like they have the last 10 years, and they're going to become much higher than what your mortgage payment is, and your mortgage payment is fixed. It doesn't change for this whole time. And so there you go. Your expenses keep increasing. They never go down. Here, though, they actually have a drop-off when you pay off the mortgage, and then it's lower, considerably lower than it would be if you rented for this full 60 years. Does everyone follow along with that? So by buying a property to own or occupy, you're able to you're voluntarily taking on more expenses now, but over the long haul, you end up having lower expenses. Pretty cool? Everyone follow? All right, awesome. All right, now, this is this chart, except I'm now going to adjust for inflation. I'm going to do this in inflation-adjusted dollars. That's what it looks like. Okay? So you start off, your expenses were fixed. Then you had an increase for your housing, but why are your expenses over time going down? It's because your principal and interest, that big part of your mortgage payment, is not impacted by inflation. You have an agreement with your lender that says it is the same number today as it is 360 months in the future. That's why your expenses actually go down in inflated dollars. Then when you pay off the house, it drops even more, and then your expenses are relatively fixed. They're flat for the rest of your retirement, because all it's doing is keeping pace with inflation. Okay? So here's an interesting question. If this is where your expenses were when you started, and this is where your expenses are in your retirement, you basically get this much extra standard of living in retirement by owning a house. Does that make sense to everybody? It's a pretty significant difference. You just look at it visually, right? It's probably half. Pretty close. So that's one of the reasons to do that. Okay. And then I'm just showing you the inflation-adjusted one when you're renting. Basically, your expenses remain flatline because it's just keeping pace with inflation, where this other one is declining. Just superimpose the two charts on top of each other. Is everyone with me? Awesome. Okay, so total amount saved. So this is basically that $1,000 you started with. When you buy your house, it dips down a little bit. You're not saving the full $1,000 anymore. Then it's increasing with inflation over time. What happens here again? You pay off the house, so now you're able to save even more to hit your retirement numbers because you no longer have a house payment. Then you go up here. What happens here? What's the big dip? Retirement. So this is where you hit financial independence. You stop working. You no longer have a paycheck coming in. And so now your savings rate goes negative. This is what you're taking out of your investment account over time. Everyone follow? Okay. So this is just comparing the one from renting, which is the yellow one. Shows you that, how much you're saving. And then when you retire, it goes down here and your expenses there. It shows you how much more your expenses are than when you own the house. So it's the owned house one savings rate compared to the renting one. Does everyone follow? Any questions? Sweet. This is the inflation-adjusted version of it. You'll notice because the line for the rental one is squared off, it's flat-lined, and then it's flat here. This one's increasing only because we actually have a mortgage, and the mortgage is not increasing with inflation. Does everyone follow? Sweet. Okay. This is one of the new measures of risk. So I'm going to pause here, and we're going to go over what this means. So there are several different ways to think about risk. We have a whole class which it's called Warning the Dangers and Risks of Investing in Real Estate. And the topic sounds really, really sexy. It's a very boring class, honestly. But it does go through methodically every single risk investing in real estate and then how to overcome that risk or how to mitigate it. And so it's a really good class for kind of evaluating what the different risks are. But if you think about it, how do we measure risk? How do we actually put a number to risk? What are some ways we could measure to determine risk in something? Just go ahead and call it out. Let's discuss this, because it's an important concept. What do you think, Joe? I put you on the spot.
Yeah, I don't know.
Okay. The chance that you lose the investment, but how do you measure it? How do you measure that chance? Could you measure something like how much cash reserves you have, as an example? That's one way to measure risk. Is it riskier for someone to buy a rental property and have zero in savings? Or is it riskier to have someone buy a rental property and have $1 million cash in the bank? Which is more risky? No savings is obviously more risky, right? What about, is it riskier to put 50% down to buy a property, or is it riskier to put $0 down? It's interesting, right? Because one could argue that if you put nothing down, you have nothing to lose. You have your credit to lose, perhaps, but if you didn't put any money into the deal, maybe not. Most people, I think, would argue, though, that putting 50% down, now you have a cushion. If the property value declines, it's not going to make you go negative on the property. If you had to sell, at least you can get part of your money back, right? What's another thing we could measure for risk? What if you buy a property and it's got $500 a month in cash flow versus buying a property that has negative $50 a month in cash flow? Which one's more risky? The negative 50, right? Because one of them, you're getting a certain amount of money each month, and if the rents decline, you still have a buffer. With the ones where you're negative 50, if the rents decline, you're going more negative. You got to feed the property. So that one's probably more risky. How do you measure that, though? right? This is the question. How do you measure a new property versus an old property? So what I'm trying to do is I'm trying to evaluate how we can measure risk. And one of the ways that people measure risk, mostly from the accounting world, is you measure the ratio of the debt you have compared to your net worth. Okay? So the higher you have in debt to the lower amount of net worth, that's more risky because you have more debt to the net worth. You can't cover the debt should something go wrong. If you have a lot of net worth and you take on a little bit of debt, that's less risky. Can everyone see that? Okay, so one of the things we can now measure is we can say, what is our total debt to net worth when we buy a property like this? And so now we waited whatever months this was, 25 months or something, and then we acquire a property, we put 5% down, plus 2.5% in closing costs, and we only had $5,000 in savings at that time. So our equity, our net worth is whatever we put down on the property, 5%, plus the $5,000 or so we had in our savings account, and then how much debt did we take on? These are $350,000 properties. So if we put down 5%, that's what, $17,000 or so? So we have $330,000 or so in debt for a net worth of maybe $25,000. So our debt to net worth in this case is really high. It's 1,500%. Because we put a little bit down and we bought a property and we didn't have anything in cash reserves except for that $5,000. Does everyone understand that? So when we're starting to compare investing strategies, now we can relate them. We could say, how much debt does this one have compared to this other strategy I'm thinking about? And am I okay with that? And so now we're going to start measuring that. So you can see up here, your debt to net worth becomes really, really high. This is a measure of risk. And then over time, as the equity in your property, you're paying off the property is going up in value, so your equity in it is increasing, plus you're saving $1,000 or so per month, a little bit less than that now, and you're putting that in the stock market, and the stock market's growing, so your net worth is growing over time. As your net worth grows and the amount of debt you have goes down, basically your risk, your debt to net worth ratio continues to go down until the point where it becomes zero when you pay it off. Does everyone follow? Okay. This is going to come back multiple times as we evaluate buying multiple properties in different scenarios. So I wanted to make sure we understood it before I jump to it later on. Is everyone following along? Yes? No? Okay. All right, so this shows you now we're doing the one property and we're comparing it to the no properties. No properties is the one in orange. This shows you your bank account balances over time. So you can see, in this case, it looks like your bank account balance when you have no properties was a little bit higher than when you bought a property. But at some point right around here, it looks like they cross over and your bank account balance for owning one property is higher than that one and it increases. Why is there a disruption in the curve right here? That's where you get to retire. So you can see visually where we're going with this. You get to hit financial independence earlier by even buying a property and not renting it out. By just living in a property as an owner-occupant, you get to hit your financial independence number earlier than if you just saved in the stock market in this case. Does that make sense? That's where we're going. Total account balances, if we adjust for inflation, this becomes flatlined. This one doesn't. It's because your property value and the money you have coming in, the money you have because you're not paying your mortgage payment, you're not paying rent anymore, you have a mortgage payment that's paid off, you basically are able to live the same standard of living and have some extra. And that's what this extra is. Does that make sense? The extra is from you're not paying rent. Rent goes to zero because you no longer have a rent payment when you own the property. And now your mortgage payment goes away when you pay off the house. So your standard of living, if you want to stay at the same standard of living you were doing before, you now have some money left over extra. And so the extra money just stays in your bank account and continues to grow. That make sense? Did you ask that question? Who's that? That was you? Sorry, I heard it from here. It was like in this line somewhere. So I was like, I got it. Okay. So here's net worth. This is your net worth with one property. You can kind of see it over time. It's like $12.5 million in inflated dollars. If we adjust for inflation here in a second, you'll see what that is. But this is the one before. Our net worth was 7.5, a little less than 7.5, compared to 12.5 when you have the property. So it's a pretty big difference in net worth. If we adjust for inflation, that's like having just over $2 million today. Okay? So when I start talking these big numbers, you're like, yeah, James, I don't really need $12 million. Right? It's because it's in 60 years in the future inflated dollars. Could you use $2 million to retire on? Yeah, that's much better, right? Okay. Goals. So this is the goal. you'll notice that at this point right here, we actually hit our 100% of our goal line. And then from here on, before it was flat, now we've got a little bit extra because we're not having to make that mortgage payment anymore or pay rent. This is comparing the two. So this is the one with one house. This is the one with no houses. Shows you the difference. The difference is if you do no properties, it's 562 months to retire. If you have the one property you live in, it's 476 months to retire. So it's just over, what is that, 40 years or so. What's that?
Could you go back one?
Yeah.
I wanted to see this, the switch point.
Yep. Looks like about 20 years in. Okay? Any questions on that? So, lesson so far, buy a house. Pretty simple. And since I'm a real estate broker, it shouldn't be any surprise. Okay. 2 nomads, 1 owner occupant and 1 rental. So remember, what nomad is, we move into the property, we live there for a year, maybe a little bit more if it takes us more time to save up for the next property. Once we have enough saved up, we buy the next property, we take this last one, we convert it to a rental. And so now we've got a rental property. How much should we put down on this rental property now? 5%. Is that better than having to put 20% down? Yeah. So now we've acquired a rental property 5% down. Now we're moving to doing the next 5% down. We live there forever. That's what this plan is. Okay. So total saved. We started off with 1,000. You bought the first house, so that your savings actually went down. By the time you buy your second house, your savings go down again. It keeps on increasing. What happens here? Yep. Retire because you're having negative savings. What happens here? Pay off the second loan. Because you have 2 loans now. So one of them actually happened on the same line. That's what allowed you to retire. But the second one now got paid off. And so now you no longer have that housing expense. And so your expenses in retirement are less. And that's what's happening there. This is the same idea comparing it to the first one. So your expenses are a little bit higher. Oh, this is saved amount. So your savings are a little bit higher when you're only buying 1 property. And you don't have the 2 houses anymore. You have 1 paid off. Second one paid off, you only have this one where you paid it off, and then finally you were able to save enough in order to retire at that point. Okay? Those are just 2 on top of each other. Total save, this is the one where we actually adjust for inflation. So you can see it just comes down, flattens out, goes here, and now your living expenses in retirement are keeping pace with inflation. We have a static standard of living. Okay? It is increasing with inflation, but you have the same living standard. Personal expenses, this is if you're renting. This is when you're doing 2 properties. Actually, I got all 3 of them on here. It's just hard to see 2 of them. And so here's your expenses where it's a little bit more expensive than renting, but then it becomes cheaper. You pay off 1 house here, pay off another house in the second line. They're kind of like really hard to tell the difference. And then your expenses are really low compared to what they were when you're renting on this chart. And this is the one where we adjust for inflation. Any questions? Okay. Number of properties owned. This was that one where we owned before. We just kept it at 1. Now we actually bought 1. We saved up for another whatever number of months that is. Probably looks like almost 2 years. And then we buy our second property. We own 2 properties for the duration. I'm going really slow. I feel like I'm moving in slow motion. But the challenge is these get really complicated. Unless I go slow now, you're really going to be lost later. Because I'm going to show you like 11 properties on the same chart. Okay? That's where we're headed. So we bought 2. Everyone with me, right? No questions? Sweet. Cash flow. So now we have a property that has cash flow. And remember, when we're thinking about hitting financial independence, we can get there by 2 things, 2 components. Number 1 is the safe withdrawal rate from any investments we have, like in the stock market. And the second thing is cash flow from properties. And so this is one of the sources of money for retirement. So basically it starts off, we don't have any rental properties until we move out of the first house and we convert that first house to a rental property. At that point, your rent actually is slightly negative. You can't hardly see it on here, but it's slightly negative. And then once you start seeing rent increases from inflation, your rent starts creeping up a little bit. What happens here? House is paid off, so now all of a sudden you have a lot more cash flow on the property, and your cash flow continues to increase over time. And this is in inflated dollars. This is me zooming in. So it shows you have a little bit negative cash flow, and then you have a lease in place for a little period of time, then your rent bumps up a little bit, and then it continues, and so on and so forth. And so early on, you have less than $50 or so in cash flow after you've owned the property for a little bit. But otherwise, you're slightly negative. Everyone follow? Now, this is an interesting point. So you have slightly negative cash flow here. Do you really have negative cash flow on that property? Who said no? Why don't you have negative cash flow?
Debt pay down,
So debt pay down doesn't contribute to cash flow.
tax benefits.
Tax benefits. So because it's now a rental, we get depreciation. So we get to depreciate that property over 27 and a half years, and we get to take the value of the building, not the value of the land. We get to divide that by 27 and a half years, and that is the amount of gross depreciation we have. If we take the gross depreciation and we multiply it by our effective tax rate, that's the amount of money we get back on our tax return, which looks an awful lot like cash flow, especially if you adjust your exemptions on your paycheck so that you're paying less in taxes each week or each biweekly or each month. Does that make sense? So really, the depreciation on the property is going to offset this small amount of cash flow, so we really don't have negative cash flow on this particular property. It is possible for you to have a property where the negative cash flow is significant enough that the cash flow from depreciation is not enough to offset it. Can you see why, if this is your first class, this is crazy, right? You're like, holy crap, James, you're just throwing these terms around like it's nothing. So I apologize. But the people that have been here a while, they're like, yep, got it, locked in. Okay? It'll come with time. So you have a little bit of negative cash flow to increase over time. This is total true cash flow, which takes into account that depreciation benefit. And so you can see it doesn't even go negative. It's slightly positive here from the very beginning, and then eventually it goes up here when you pay off the house and it increases. Is everyone follow? Okay. Whoops, skipping slides. This is the total amount you have in the accounts. Whoops, I guess I did inflation adjusted. Total amount you have in the accounts just shows you that owning no properties, not as good as owning one property, not as good as owning a property and a rental. So this is the one where you have a rental, and you can see the money you have in your bank accounts at that point is $12.5 million in inflated dollars. In inflation adjusted dollars, it's just over $2 million in your bank account, just over 1.5, and just over $1 million. Depending on whether you have 0 properties, one where you live in, or one where you rent and one where you live in. Yeah, question? Yeah, so the one you live in, for the middle line, you move in to live in the property, but you never buy the second one. So imagine it's a nomad that comes to meet me for lunch. We talk about they want to do nomad. We say, great, let's buy your first property, then come to class for a year. You could decide if I'm crazy or not. They move into their first property, and then a month later they meet their significant other that they want to marry. The wife or the husband says, no way I'm moving every year. Okay? And they just bought that one house, and that's the one they live in. So they just bought the one house and they live there forever. That's that case. Okay? But if they do it one more time, they're like, hey, listen, we can keep this old property I had. Let's go move into this one other property. We'll keep this other one as a rental. That's the top line right here that we just did. And we're going to go and add 10 more.
And they don't have roommates.
In this case, there's no roommates. Yep, this is just straight up, you're living in the property. So you're living in it by yourself or with whoever you want. Okay? All right, so here's risk again. So isn't this interesting? So before, we didn't have this second hump. It's like a one-hump camel. This is the peak right here when we bought that first property with 5% down. Then what happened? We saved up money as we started paying down the loan. That property was appreciating. We had a little bit of money saved up in the stock market. It was growing. And then what happened here? What's this second little peak? We bought another house. And we bought another house with 5% down. So why isn't the peak the same? Right, because you have some equity in the previous house and you have a little bit of savings still. So now all of a sudden, instead of actually seeing the same peak we had before, you have less risk buying your second property. Your biggest leap of faith from a risk standpoint when you're talking about debt to net worth is the first property you buy, unless you have a ton of stock market money somewhere else and you're taking a very small part of your portfolio and you're investing it here. But the biggest leap of faith is when you're tight on money for the first one, you have $5,000 in savings and the down payment and the closing costs, and you buy that first property, that's your big risk. And you take it early on. It's front-loaded. Would you rather take risk when you're 20 years old, or would you rather take risk when you're 60 years old? 20, because you have time to recover. So this allows you to do that. It allows you to front-load your risk, and then the next one you buy is less risky than the first one. Does everyone follow that? Okay. So this shows you both of them. This is just the same one we had before. That's that orange one, single little bump. And then you've got two of them here where you bought two properties. Everyone already saw this. I just want to show you on the same chart. Because these are going to get complicated too. We're going to overlay 11 properties on it. Okay. So remember 2 weeks ago when we had a snow day? We canceled class. And I had this amazing 2-hour presentation I was going to teach on 6-hour presentation on return on investment and return on equity and how that impacts your ability to hit financial independence. Remember that class? Yeah, the ones you guys never got. This slide is basically a 2-hour class, okay? There's variations of it to go into it, but this is like a 2-hour class by itself in that night. And what this chart is basically showing you is there are 4 different areas of return you get by owning a rental property. And I've covered this in other classes before, but they are appreciation, the tendency for property values to go up over time, usually from inflation, but they tend to go up over time. Debt pay down, paying down on the loan that you have from the lender. Cash flow, the difference between your rent that you have coming in, all the expenses on your property. And then cash flow from depreciation, the tax benefits of owning the property times your effective tax rate, okay? So what's interesting about this chart, and I'm not going to teach the 2-hour class here tonight because I've already got 306 slides. However, you can see that the blue stuff is appreciation. So you have a really big appreciation. This is our return on investment. So the return you're getting as a percentage on the initial amount you put into the deal. So you can see that you have a big return from appreciation. You have a medium return from debt paydown. You have a negative return from cash flow because you have slightly negative cash flow at the beginning. And then you have a small return from cash flow from depreciation. And you can see at the very beginning, these are relatively small. Over time, your depreciation goes away after 27.5 years. That's the yellow line. Your debt paydown goes away right here. What happens? What year is this? We all know. 30 years in. So you lose your debt paydown return right there. Then your cash flow increases a lot. It kind of takes the place of this. So you're seeing a huge jump up there, and then your appreciation is continuing to go up. By the time you get to like year 30, though, you no longer have depreciation, cash flow from depreciation, and you no longer have debt pay down. All of your return is coming from appreciation and cash flow. But early on, you get these boosts to your return from cash flow from depreciation and debt pay down. Everyone follow? This is return on investment. So it's figuring out what the percentage return you're getting from the initial amount of money you put into the deal. And it's pushing like 80%. Why is it so high? Why is your return on the initial investment so high in this case? Very small upfront investment, right? You put only 5% down. So you have a really small amount in, $17,000, and you're getting on a $350,000 property that's going up 3% a year. That's like 10 grand a year. So you're getting like almost, is that 50%? It's hard to do math in front of the room. Is that like 50% return just from appreciation alone? Brian, how's my math?
I'm thinking about something else.
Okay. Brendan, where's the other math geeks in the room? It's like 60? Yeah, so whatever it is, it's really high just from the appreciation alone, right? You're seeing this big thing. But then, is return on investment really a good measure to use long term? I mean, you're down here. Does it really matter that you only put in $17,500 like 30 years into the deal? Absolutely. You could sell the property and take all the money you have in it. It's not the $17,500 anymore. It's all of your equity. So wouldn't you rather think of this in terms of something other than your initial investment? What might you otherwise want to calculate it on? Not initial investment, but what? Equity. So return on equity. That's this chart. That was part of the presentation, the 2-hour presentation you're not getting tonight. So in this case, your equity is really small when you buy the property, so your return is really, really high. It's like over 30% in this case. However, over time, because your equity is building and your returns are going down in at least 2 of the areas, the amount of money you're getting return on equity goes way down until it's below 10%. Does that make sense? So this is like a different way to look at it, and this, in my opinion, is a much better metric to use when you're talking about what return you're getting. Because you have to think about, what's my alternative? I have this certain amount of money tied up in equity in the property. I could pull that out and put it into something else. I could go buy Beanie Babies, or what are those things called? The Pop Kids, or whatever they're called, the little like superhero things. What are they? Fun Pops or something. I don't know what they're called. But you could go take all your equity in your property, you can go buy those. And those could go up 30% a month, right? So instead of thinking about how much money I had initially, it's much better to think about how much equity you have and what your return is on that. Because this is what you compare to, if I could take this money out and I'm not getting 10% anymore on my property, and I go invest in the stock market and I can get 10%, maybe you want to do that. Or maybe you want to sell at this point and buy 2 properties and get back to the beginning of the curve. Bump, you're getting all these big returns here, and then you sell it and do this. This is what the whole other class that you're not getting tonight was all about. Okay? You have a microphone?
Does your depreciation and your loan pay off at the same time?
No, not always. It depends, because when you start renting it, it's 27 and a half years from when you rent the property, but you may have been living in the property for 2 years or 3 years when you're doing nomad.
I just wondered if you did the 27 and a half, 'cause it looks from here like it's the same place.
In this particular case, it might be because, remember, this is a property we lived in for 2 years or so while we were saving for that second property, and then we converted to a rental. When we converted to a rental, it's 27 and a half years from then. So in this case, it could be exactly the same, but they're not always the same. Yeah. Good question, though. Okay, so this was return on investment, which I'm not showing you tonight. This was return in dollars. This shows you the dollar amount that you're getting from each one of these areas of return so that you can see the relative amounts. I'm not covering that tonight. And then this is return on equity, which I'm also not covering tonight. Any questions on the things I should have taught a 2-hour class on for the snow day, but I'm not covering tonight? Oh, got a question.
Are all these assuming we're holding the properties until death? We're never selling them?
In this particular case tonight, yes, we are. The question was, are we assuming we're holding the properties until death? We are never selling them. And the answer to that question is yes. In this case tonight, we are never selling these particular properties. If I started doing sales, it would be much more complicated. All right, any other questions on the stuff I'm not teaching tonight? Microphone. You should just let him hold it.
Didn't we once prove to ourselves that like the limit as time goes on of the return on equity for houses in that area like approaches like 8 to 9%? Like all these.
Well, it depends on what we're using for our assumption for appreciation, because 3% of it or so, if you're using 3% appreciation, becomes that. And then it's whatever the cap rate is in the property. And so if your cap rate in your property is 5% and you're getting 3% from appreciation, it's 8. Because at the end, it is cash flow and appreciation.
I just remember running like every property that we looked at for like
Yeah.
3 months and looking at this going, oh yeah, they're all about the same.
Yes. Yeah, so it actually approaches cap rate for cash flow, and it approaches whatever your raw appreciation number is, because it's unleveraged at that point.
Are you going to teach that class soon? Are you going to put it back in rotation?
Probably not. The question was, am I going to go teach the class that I never taught? And the answer is probably not. I don't know. I probably will. I really shouldn't say probably not, but I don't know. I have to go look at it. It was crazy. I was getting all excited.
Yes, he will teach it on the next page.
Oh, Brian says I'm teaching it. All right. Yes, that'll be my mini topic class. That's right. Be like, look here, in chart A4. Yeah, that's very funny. All right, so net worth. Let's talk about net worth for these properties. This is, again, 2 nomads. So basically 1 rental, 1 owner-occupant. This is 1 owner-occupant, and this is no properties. So net worth is, I don't know, just below 16-ish, just below 12.5 million, and just below whatever this is, 750,000. So that's net worth. This is adjusted for inflation. So adjusted for inflation, it's like just under 3 million, just over 2 million, and just over 1 million in inflation-adjusted dollars for net worth in those three cases. Oh, and because I can't read them, this is what the numbers are. So 1.2, 2.0, and 2.8 million. That is in inflation-adjusted dollars in the last month. So 60 years in the future is what your net worth differences are between owning no properties, owning 1 owner-occupant, and owning 1 owner-occupant and a rental. Everyone follow? All right. Halfway through the hour. We're like 1 hour in. Making good, I don't know how many slides. There's no way we're getting through 300 today, I can tell you that for sure. Okay, so this is that the 2 property one where you have a rental and you're 1 year owner occupant, and it shows you where you are toward achieving your goal. You basically achieve your goal when this thing gets paid off. That's why the big bump is there. And then it continues on up there. And what's interesting about this is kind of this point. The further above this 100% goal line you are, the more either safety you have if you continue your standard of living, or you can raise your standard of living and tap into this more such that you can raise up, this basically is a $4,000 a month standard of living. If you decide to go and tap into this, it could be a $6,000 a month standard of living because it's 150% of your goal. So you can decide to have a higher standard of living by doing this. And you're going to see something very interesting. It came up in the Financial Independence Retire Early class, FIRE class, where, yeah, it's pretty funny, guys. It came up in that class, and the point was in that class, we found out that sometimes buying fewer properties meant you could retire earlier. It was counterintuitive Because what ended up happening is you ended up getting to the point where buying additional properties took money away from other investments you could make that would have gotten you there just a little bit faster. But what happened, though, if you ended up buying additional properties later on? Does anyone remember? Higher standard of living. So just because you could get to retirement faster didn't mean that you were going to have as high a standard of living if you went, an extra 2 properties or 3 properties. Then you could actually live at a much higher level, even though you didn't get there as fast. And it was pretty interesting to see that. Okay? All right. Any questions on the goal? I'm actually looking when I ask if there are any questions. Usually I'm just like, boom, right over to the next slide, but I even looking back. Okay, we're good now? So these are the 3 different goal lines. No properties, one where you own or occupy, one where you have a rental, and the other where you own or occupy, where you have 2 properties total. This shows you how quickly you achieve your goal, because this is time down here. So the earlier they hit this red line, the earlier you're able to hit financial independence and retire early. And then in case you couldn't read those numbers, I made them easy for you to do. 562 months if you don't have any properties, 476 months if you just buy an owner-occupant property, and 384 months if you buy 1 rental property and you live in another doing nomad. Okay? So the kind of question for tonight's class is just 1 more rental property. So just 1 more means you can retire whatever this is 7 years earlier. If you do this one, you can now retire, Brian, 7 years earlier. Okay? So you can see what 1 rental property means in net worth, but net worth is kind of it's a relatively arbitrary thing, right? Really what you want to know is when do the assets you have actually support you in retirement? Right? Isn't that how many people think net worth is more important than when you can get to the point where you hit financial independence? Which one's more important? Let's see you raise your hands. Net worth. Okay, 1 person. How many people want financial independence number? Awesome. See, I think that's a more important metric, and that's why this is really critical, because it shows you how long it takes for you to get to that point where between your safe withdrawal rate from your stocks and the cash flow you have coming in from your rental properties, when you hit that number. Okay? All right. Now, let's switch gears. So up until this point, we were doing nomad. We were moving into a property, we were living there for a year, then we'd buy another property, move in there, and we'd convert the last one to a rental. We're changing it now. We're still going to buy a property as an owner-occupant and live there, but instead of actually saving up for 5% down to buy our next owner-occupant, we're like, no, the spouse says we're not moving. We love this house. We're staying here. However, we do want rental properties. So I'm going to save up 20% so I don't have to move into the property, and I'm going to put 20% down and buy that other property. Now, some interesting things happen when we put 20% down. Remember before when I talked about PMI? Why did we have to pay PMI? Because we only put 5% down. So now that we're putting 20% down, do we have PMI? No. So in fact, we end up having to put less down overall, not then the 5%, but less down in closing costs. We're going from 2.5% in closing costs, which included upfront PMI, to 1% in closing costs, which is a much more reasonable amount to pay in closing costs when you're not doing upfront PMI. Okay? So we save a little bit of money on closing costs there. What else happens when you do an owner-occupant loan versus an investor loan? What happens to interest rate? It's higher. What's the difference? Anyone know? I don't even know the difference. I'll tell you what the interest rate for owner-occupant is. 4.375 is what we used here, because that was the quote I got from the lender the day I made the presentation for the other class. So I used the same numbers. 4.375 for owner-occupant rate, and then the investor rate was 5.125. So that's what, 5/8? What's that?
It's 5.375 right
For the investor loan?
Yeah.
Yeah. So it changes every day. Okay? And it depends on how much you put down, if you're going to pay a point up front, you're not going to pay points, or how your credit score is. It's impacted by a lot of things. What loan it is, if it's your 5th loan spot versus your 1st loan spot. So a pretty significant difference in interest rate as well when we're doing these 20% down loans. So how much is that going to impact things? And more importantly, how much longer do we need to delay buying a property because we're saving up 20%? In fact, that time may be the most important factor. If we're trying to hit financial independence and retire early, if we have to wait an extra year or 2 years or 3 years in order to buy this 20% down property, that's a huge deal. Because now we're buying a property that's more expensive. We're waiting to actually get that and have the debt pay down start happening and our appreciation start happening where we own the property. So it has a lot of impacts on things. Okay, so let's take a look. So number of properties owned. So this is 2 nomads, the red one, well, they look red to you, right? Both of them look red. So this is buying 2 nomad properties. This is when you buy the second one. First of all, we buy the first one the same time. I should say that. Because we're buying the first owner-occupant property, we're putting 5% down. It's identical whether we're going to do the next one at 20 or the next one at 5. Does everyone follow that part? Okay. So the first one happens all at the same time. With Nomad, though, we're able to save up and buy this second property much sooner. Months sooner, whatever this is. 30 months, 40 months, whatever it is. And then we buy the second one with 20% down much later. So they're overlaid to show you the 2 different scenarios and compare them. One you buy way sooner, the other one you buy much later, and then we stop and we buy 2 properties. Does everyone follow this chart? Okay. Personal expenses. Who knows what's going on here? So basically, your personal expenses increase when you buy your first property, and since you're not buying another property to owner occupy, you don't see this second bump. You're basically saving, and because you're not living in the property, it doesn't show up on personal expenses, so your personal expenses remain the same. And the other one where we did the second Nomad, when you bought your second property, your personal expenses increased again. And so you have a little bit bump, and it's a little bit higher. And then this one, the one where you bought the 20%, you end up paying off that first house you live in early. Because this one is the second house you bought. That's when you pay off the second house. Because that's the one you're now living in, so that's counted as your personal expenses. The second one, where in the 20% down, the first one you moved in is the one that's your personal expenses. So when that gets paid off, your personal expenses go down. Does everyone follow that? Because I think I confused myself when I said it. Anyone not follow it? You didn't follow it. So when you're owner occupying as a nomad,
Which is which one?
the red line. So that's nomad. So when you buy it, you're buying your second property and you're moving into that one. So now that is covered under your personal expenses. So you got to wait for your second property to pay off before this drops down. When you do the 20% one, you're living in the first property still. And so it's just when the first property drops off that your expenses decrease. Did I say it better the second time? Does everyone get it? Anyone still missing it? Okay, good. And then you can see your expenses kind of increase over time from there. Total saved, same type of idea we covered before. I'm not going to cover this chart unless you guys really want me to. I'm going to try to make up a little bit of time and show you some cooler stuff. Everyone with me on the saved amount of money, just showing 2 different scenarios and where we save money and then when you retire and when things get paid off. Is everyone with me? Anyone want me to cover this one? Okay. Total account balances. So this is buying 2 nomads versus buying 1 nomad and 120% down. This is the amount in your bank account. It's not that much of a difference, except you got to realize this is $10 million. So small relative size. This shows you your total account balances for all 4 scenarios. No properties, 1 property, 1 where you do 20% down, and then the one where you do 2 nomads. So it shows you the relative account balances between all of them. And if I'm smart, I'd probably put one where, yeah, see, I did it. So these are the account balances, inflation adjusted. So no properties, 1.2 million. 1 property where you owner occupy, 1.7. This is where you do the 20% down, so that's 2 million. And then 2.1 million is the one for doing nomad. So another way of saying this is it's $100,000 better money in your bank account 60 years in the future by doing nomad versus doing 20% down, assuming all of these assumptions. $5,000 income, $4,000, all that stuff. Okay? That's what our assumptions say. So it's about $100,000 difference, just those 2 scenarios. Who thought it was going to be better to put 20% down? Raise your hands. Yeah, right? It's surprising. And what's the reason why? Why do you think this is happening? Because you're buying it earlier is the real key. You're able to buy a nomad property much earlier than you can do the 20%. So you have to save up time. Okay? All right. Net worth, same type of idea. They're relatively close, except you got to realize it's $15 million right here. So net worth difference, no properties. 1 property where you owner occupy, the 20% down one, and then the 5% down nomad one where these are 2 rentals. Okay? And I think if I'm smart, this is the inflation adjusted version. Here it is, the inflation adjusted dollar amount. 1.2, this is net worth instead of account balance. Account balance was before. 1.2 net worth, 2 million net worth, 2.7 net worth, 2.8 net worth. So the net worth difference really is only the difference between that $100,000 or so you had before. Now, why does that confuse anybody? Why would your net worth be the same even if you had the properties bought at different times? It's a rule of thumb that I wanted to bring up, so I'm glad this kind of came up at this point. Anyone know why that is? What's that?
Same amount of properties.
Same amount of properties. That's actually it. So here's the interesting thing. You're thinking about buying 2 properties. And they're, in our model, they're the exact same property. They're basically $350,000 properties today. Now they're going up so that if you buy it 5 years from now, it's worth more, so you're paying more for it. But when you pay off the properties and you no longer have mortgages for them, you still own 2 free and clear properties that were worth $350,000 today. Even if they're worth $1 million each in the future, what are they really worth in today's inflation-adjusted dollars? $350,000. So if you want to think about this, if you want to say, hey, listen, I go buy a certain number of properties, I'm going to have $14 million in the future if I kind of have inflation at 3%. Really what you want to do is think about it in today's dollars. So the way to actually think about it is you say, I really want about $2 million worth of real estate today. So you use today's dollars in order to do that math. You can basically say, I want $2 million in today's dollars. I want to have it feel like $2 million in today's dollars, even if it is $14 million in the future. So I need to divide the number that I want by the value of the properties that are today. So $350,000 properties. You can divide through and figure out how many you need. The same applies for cash flow. How many people know the rule of thumb for what cash flow, what percentage of rent is applied, is actually free and clear cash flow when the property is paid off? If you have a property that's renting for $1,800, if you jump into the future, what is that worth when the property is paid off in terms of free and clear cash flow? What's the rule of thumb for that? Anyone know? 2/3. So if you basically say you have $1,800 a month property, when you have the property completely paid off, a really rough rule of thumb is you're going to see about $1,200 per month in cash flow on that. About 1/3 of the rent coming in is going to go toward maintenance on the property, vacancy on the property, property management, things like that, taxes, insurance, all that stuff in there. Okay, so it's a really rough rule of thumb for doing that. So if you want to go and you say, I want $10,000 a month in income in retirement, what you could do is you could say, I'm going to be buying properties where the rents are about $1,800. So my free and clear cash flow when these properties are finally paid off is going to be about $1,200. So you take $10,000 that you want, you divide by the $1,200 that you're going to get when they're paid off and free and clear, and you can figure out how many properties you need to buy in really rough terms for the future. Is that a helpful rule? Okay? So you can quickly do some math on that. Now, in the future, they may be $25,000 a month in cash flow or whatever it is, right? But really, when you adjust back in time, it's going to be the amount that it is in today's dollars. It'll feel like that amount in today's dollars. Okay. I think that's it. No questions on this one? All right. Here we go. Percentage of goal achieved. So now this is no properties. This is the one property where you own or occupy. The yellow one is the 20% down rental, where you live in one property. And the green one now is the one where you do 2 nomads. You have one rental and you live in the other. And you can see when they hit their retirement number, and this kind of zooms in. So 562 months if you don't have any properties, 476 if you live in one property, 408 if you buy a 20% down property, or 384 if you do nomad. So you're able to retire, where's Brian? Where's my math guy? 16 plus 8 is what, 24? So 2 years earlier, you can retire 2 years earlier if you nomad. Is that interesting? Okay. Oops. All right, I'm gonna fast forward now. I'm gonna do 11 nomads. So what we're gonna do is we're gonna own or occupy a property. I'm gonna live there for at least a year until I save up money for my next down payment. I'm gonna buy the next property, convert this one to a rental. I'm gonna live in this second property for at least a year, save up my money for a down payment. When I can buy the next property, I buy the next property, I convert this one to a rental. Live in this one for at least a year, save up my down payment. Repeat this until I have one property that I live in and 10 rentals behind me. Does everyone follow? Okay? So, this is the number of properties owned, and I show no properties, that's the line, the flat line at the bottom. I show buying one owner-occupant property, this is the purple line. Then I show you buying 2, buying 3, buying 4, 5, 6, 7, 8, 9, 10, 11. Okay? So, what do you notice about how quickly we're buying these properties? Does anyone notice anything interesting about this? Like the timing between these gaps?
smaller.
Yeah, it's getting smaller as you go up. Why is that? Why are we able to buy properties sooner the later we get? When I told you, you have to wait at least a year.
You're making money.
Yes, because you are saving more. You're having a little bit of cash flow contribute to that. So you're able to go ahead and buy the property sooner and sooner. It took you longer to save up for this one, then you have to save up for this one, then you got to save for this one, save. But by the time you get here, you're probably just waiting the 12 months, right, until you can buy the next property. And so it shows you how quickly you can acquire properties to do this. Okay? Any questions on this? All right. Net worth. Just goes to show that no properties, 1, 2, 3, 4, 5, 6, 7, till you get to 11. And when you get to 11 properties, your net worth is $70 million. Okay? Adjust for inflation, that's really $12 million in today's dollars, adjusted for inflation. It's 11 if you only buy one. If you buy 10, 9 million, almost 10 here, almost 9, almost 8, 6.7, 5.7, 4.6, 3.7, 2.8, 2, and then 1.21 if you don't buy any properties. So you can see your net worth tends to increase the more properties you buy, adjusted for inflation. Is everyone follow? See why I went slow? So I want to be able to just show you this quickly and you guys understand what's going on mechanically. Cool? Okay. Account balances, same type of idea. This shows you how much money you have saved up in that stock market account. That peak there is just under 50 million. So one could argue, if I had unlimited time to teach this class, we could take some of this money once we're done buying and we could do what with it? We could pay off houses and see what impact that has, paying off houses quicker, right? So we could do stuff like that. Or we could buy 20% down properties. Or we could sell off some and pay off the others. There's all sorts of variables. All right, so here's the total account balances. So 8 million in 8.2 in cash, 7.5, 6.8, and you can see down the line, we just have a decreasing amount in the bank account, and this is in inflation-adjusted dollars in month 720, which is 60 years in the future. Okay? Total cash flow shows you your cash flow over time. You can see cash flow starts off as a trickle. And over time, as you add more properties and as rents go up and you have a fixed mortgage payment, your principal and interest part of your payment is fixed. Your taxes and insurance do go up, but that's a small percentage. And so over time, your cash flow on these properties tends to increase. And so you start seeing some houses get paid off. You see little bumps coming up. And you can see cash flow increases until finally it's $80,000 or $85,000 or whatever it is in inflated dollars in year 60. If you adjust for inflation, it's like having $15,000 a month in free and clear cash flow after all expenses. Okay?
Wasn't the financial freedom like $4,000 a month though?
Yes. So we'll show you when you hit financial independence on all this stuff, but this shows you how much dollar amount in cash flow. So is your lifestyle better if you have $15,000 a month coming in from cash flow on your properties, plus like $8 million or whatever it is in your bank, so you can actually take a safe withdrawal rate if you wanted to from that. But you have this, when your standard of living before was, as soon as I get to $4,000, I'm out of the rat race. I'm financially independent. Does that make sense, everybody? You have a lot more coming in here. So remember, if we have a rule of thumb for the cash flow, let's check our rule of thumb and see if it works. I think the cash flow on this property, I think we set it up at about $2,000 a month or so. So about 60% of that would be what? $1,400 or so? It was pretty close. It's 15,000 times 10 rentals. So that rule of thumb works pretty well for estimating how much cash flow you have in the future. Okay? So you can see that here. So one interesting thing about this, I was writing kind of like an article sort of thing, and the headline of my article was, are 2 to 3 rentals enough to retire comfortably in Fort Collins in northern Colorado? And if you make $4,000 a month, there you go. Is that enough? So you got 3,000 a month here, 4.6 here. So you really don't need that many. I think the purple one is, so there's no properties. This is 1 rental. This is 2 rentals. This is 3. So there you go. Any questions on total cash flow? All right, so here's an interesting one. So depending on what property you buy, you might have a small amount of negative cash flow on this property. Now, we talked already about the idea that cash flow from depreciation, the tax benefits, can offset some or all of that cash flow. But in this case, we're not taking into account cash flow from depreciation, and I'm showing you how much in total cumulative negative cash flow you've had on your property over the entire life of the property itself. And so you can see when you buy one property, when you buy no properties, you don't have any. When you buy your first property, you have a little bit, but it basically goes away after a couple months. When you buy that second property, you have a little bit more negative cash flow. When you buy the third, you've got a little bit more negative cash flow. When you buy the fourth, you've got more. Fifth, sixth, seventh, eighth, ninth, 10th. By the time you get to that 10th rental property, you've got pretty significant negative cash flow. Now, this isn't per month. This is the total amount of negative cash flow you paid into the property over all time. So it's a quick sum of all of it. So the total amount, if you buy 11 Nomad properties in this particular scenario, and this is unusual, usually it's a little bit more than this, but in this particular example, you have about $5,500 in total cumulative negative cash flow across all properties. Okay? This is the total amount invested in all the properties, including the negative cash flow. So this includes closing costs, down payments, and negative cash flow, and it sums all of them up to show you how much you needed to invest in total. So in total here, it's just over $350,000 over the course of, I don't know, almost 200 months in order to get to the point where you're able to acquire 11 rental properties. And you're doing that by saving 5% plus 2.5% closing costs and making sure you have a little bit of cash reserve, buying your next owner-occupant property, moving in. And then you have a little bit of negative cash flow on some of them. But the total amount in aggregate for the full 11 is $350,000. Does everyone follow what's going on in that chart? Anyone have questions? It's awesome, right? That's like one free and clear house. Yes. Yep. Okay. And the other interesting thing, I don't think I show it on here, but these are in inflated dollars, right? So you don't even have this much in today's dollars. Do you have a question? Yeah. Microphone. Yes. We're using the same interest rate for each house if it's owner-occupant. We're using a different interest rate if it's 20% down. We're using the investor interest rate in that case. Yeah. Yep. Okay. Total mortgage balances. So this shows you the sum of all the mortgage balances on the property. So at this point, it looks like you owe just over 4.5 million or so when you have all 11 properties. And then you can see the aggressive pay down over time as you pay off some of them. So you get to all of them. Is there like a buzzing? Mm-hmm. I thought that was like my hearing going. Okay. And then here's your total mortgage payments of the rental. So it adds up how much each one of your mortgage payments is over time. And then as they pay off, the kind of whole chart slides down. So it shows you the sum. Your total of all your mortgage payments is just over $20,000 a month in mortgage payments. Okay? Okay, here we go. This is that risk chart again. And it becomes super interesting to me to think about this. Because where's your biggest risk? The first property. The first property you buy is your biggest risk. This is your leap of faith. This is the cliff for leap of faith, I guess. Right? Because you're jumping off the top of this puppy. You're buying the property for the first time here. Then you start building up a little bit of equity, and you end up buying your next property about, I don't know, a little bit less than half, a little bit more than half as much risk when you buy your second property. Then when you buy your third, it's even less than the second. Then you keep buying them. Each progressive property that you buy has less and less risk. And then your risk curve declines pretty rapidly after you buy them. Okay? So your risk curve, and what happens is it's also very front-loaded. So all of your risk happens way up front. Where later on when I show you the 20% properties that you're buying, you can see that you're buying those out here. So you're taking on this new risk for these 20% down. You're extending out your period of introducing new risk. At this point, you're not introducing any new risk. Okay? You're improving on your risk position. Does that make sense, everybody? Mm-hmm. We've never taught the risk class, and there's probably a whole class on this stuff, but is it pretty interesting? Or is it just me that's like fascinated by this stuff? People like that? Do you overlap the two? Yes, for the 20% and for this one? Yeah. I'm going to overlap everything. I don't know why I asked. What was the understatement of the evening? What was the understatement of the night? There you go. Can you see where I'm going with the I like chart stuff? Okay? All right. So here's another measure of risk. We talked about this one. Is it better to have a property that you have $500 a month cash flow where you could see a decline in rents and still be able to support the property and not have them be negative? So another measure of risk, in my opinion, is what I call rent resiliency. It's how resilient your rent is to seeing negative cash flow. How far down in dollars can your cash flow decline before you get to the point where it's negative? And so you can see in this case, Early on, you have like no rent resiliency because your property is basically at break even or slightly negative, right here. But over time, as cash flows tend to increase, your rent resiliency also increases. And the earlier you buy your properties, the further over this curve shifts. So this is another way to measure risk, a totally different perspective on it. Okay? You look at both. You say, hey, listen, what's my risk in terms of debt to net worth? What's my risk in terms of rent resiliency? Okay? Any questions on this idea? It's a dollar amount that rents can decline before you actually have negative cash flow. Everyone get that? So this shows you here, if we adjust for inflation, your rent resiliency, once the properties are all paid off, is about $17,000 or so per month. Okay? Same chart, just adjusted for inflation. Goals. So these are all the goals for all 11 Nomad properties. You can see that they're getting progressively smaller and smaller. I think I have a zoom. There you go. Nice job, James. So basically here is no properties. Here's the one just owner occupying. And then here's you buying Nomads where you start having rentals. What's happening in here? They're starting to look like it's not making much of a difference in achieving your goal. Didn't I foreshadow this earlier? Right? When I said fire? You guys are way slow, by the way. Right? So here it is. This is like basically the same idea we're talking about, where it's not making a significant improvement in your ability to hit your financial independence date by buying more properties. And you could see it here. So this is no properties, 562 months. This is the one property you owner occupy, 476. This is one rental, 384. Two rentals, 326. 295 is however many rentals that were supposed to be there. 275, 258, 252. And then here, it's 240 no matter what, whether you buy 11, 10, 9, or 8. Doesn't make any difference in terms of financial independence date. But where does it make a difference? Net worth, where else? What's that? Cash flow, definitely. What else?
Quality of life.
Standard of living. Yes, absolutely. So you have a higher standard of living you can support yourself on because you bought those extra properties. Okay, and actually you can see it here, right? All these curves are getting higher and higher. So this is what percentage of that $4,000 target income you had that you're able to do this, right? So every time you buy another property, you have a higher standard of living than you did before, even though they all cross right about the same spot. Does that make sense? Okay.
So on that slide,
This one?
it seems like there's an error.
This one?
Yeah.
Okay.
Like, if you look at the blue, the light blue, 275 to 258. Light blue, 275 to 250. Is it 258?
Yeah.
Yeah. So then 258 to 252 only drops 6, but then the next one drops 12 months. How is that possible?
Yeah, I don't know, but the math is right because you end up buying, weird things happen where you buy properties and you end up like not buying the next one, and that actually allows you to have stock market money where you hit that number sooner. There's some weird things that are interacting. It's not linear.
Yeah, it just seems like they're all coming down less and less. It's like that one just seems out of place.
Yeah, it is not linear. There's some really weird, like, it's almost like, what's that mathematics, Tammy, where it's like discrete math or something like that, where you get to a certain point and then you have these jumps in the things. Is that what it is? Okay. Any other math geeks here take discrete math? It's like sometimes you have like a crossover point where you put money in, it doesn't make a difference, and then you hit the like tipping point and it goes up to the next one. Yeah, it does some weird stuff like that. Yeah. See, it just won 100 burritos. Okay. What am I teaching now? I don't even know. Up to 10 rentals. Oh, this must be doing the 20% down version of this. So before we did 11 Nomads. Now what we're doing is we're saying we're going to buy the owner-occupant property. We're going to live there. And then the spouse is going to say, we're not moving. You got to save up the 20%. I don't care if you do the real estate stuff, but you got to save up the 20% because I'm not moving into any properties. And so this case, you save up 20%, you buy a property as a non-owner occupant, you put a tenant in there from day one, and you buy 10 more rental properties. So you have the same 11 properties we had before, you're living in one, and you have 10 rentals, but instead of buying it with 5% down, you bought all 10 with 20% down. Everyone follow? Okay. And I might do some comparisons to 11 Nomads. Okay, number of properties owned. This chart looks very different than we had before, doesn't it? You have a little bit of time before we buy that first 5% down property. We then get one property. Now we're saving up to get 20%. A lot longer time to save to get that first 20%. Then we buy a property. save up for 20% again, then you buy a property. Save up for 20%, buy a property. 20%, buy a property. 20%, buy a property. Eventually, you're doing this. What's interesting about buying 20% down properties? That's different than when you buy 5% down properties, besides the down payment amount.
Takes you longer.
Takes you longer is true, but do I have to wait 12 months? No, because I'm buying owner-occupant properties to require you to live there for a year. When you're buying non-owner-occupant properties, I could buy 3 in a month. Although you may not want to do that if you're on the cusp of your loan spots, as some people in this room may know. So you don't have to wait the 12 months. These could be bought 11 months apart or 10 months apart or 6 months apart if you had the down payment. Okay? All right, so that's number of properties owned. Now I'm going to do something magical. At least I think I'm going to do something magical. It's 306 slides. I can't remember the order of every single one. But I think this is coming up here if I click this button. Here's something interesting. That's buying 11 nomads. Shows you how much faster you're able to acquire 11 properties versus the 11 properties doing 20% down. It's huge. And buying properties earlier means you're buying less expensive properties, and now you're also having the properties for a longer period of time, and you're able to achieve financial independence earlier. Make sense? Okay. Total invested in rentals, including negative cash flow. So basically, it shows you how much you invested for your down payment for property 1. This is just rental, so it doesn't show the owner-occupant property. Rental 1, rental 2, rental 3, 4, 5, 6, 7, 8, 9, 10. In order to get 10 rental properties, you had to invest your own cash, $1.25 million, and that includes any negative cash flow you might have had in the property. Now, anyone notice anything super interesting about this chart?
Is that versus the 350 on that one?
Yeah, so you can see the Nomad ones hidden behind it. That's the total for the Nomad. So basically, the Nomad ones, this is when you had your down payment for your first Nomad property, your first rental Nomad property, 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 10th. It stops here and is flatlined right here. You can see the little edge where it comes out the other side. So it shows you the difference between how much you needed to save down payments, closing costs, and negative cash flow compared to down payment, closing costs, and negative cash flow for 20% down to acquire the same number of properties. Big difference. 350, 1.25 million. Yes, Brian.
Are you going to show an overall loan-to-value chart for both of those situations across time?
Well, loan to value.
Because that's another measure.
Oh, I do. I do have loan to value. Well, debt to net worth is a measure that we use for that. But loan to value is a different one, and I do have something for that.
Yeah, debt to net worth is not the same as.
Agreed. I agree with that. I have loan to value. I don't know if I included that chart. I have a 306 charts in there, but not that one.
We need to add 300%.
We can discuss it.
Yeah, we can discuss it there. Yeah.
So does this Nomad model, represent roommates helping you with,
No.
with the payment?
That's a great question. Does it represent roommates helping you with payments? It does not. It assumes you are covering the entire mortgage payment yourself. I think in this initial assumption, I assumed you were paying rent of like $1,800 a month, and then when you bought your property, the $1,800 a month rent went away, and the full mortgage payment was considered part of your expenses, and that's why there was that little bump up every time you bought a property, is that your expenses increased by a little bit more than what the rent was. So you are covering the whole payment. You get roommates, it's improved. It's faster. Yeah. Any other questions? Sweet. Total property values. So this shows you the property values you have of the things you own. And this red line is your Nomad ones because you acquired them earlier. You basically own these properties at this point. This shows you the delay in when you acquire them. But basically, since we're talking about the same properties, once you own all of them, the property values for owning 11 properties or 10 properties is the same. Does that make sense? So these curves are identical once they get here, but you're buying these properties sooner, so you own them faster. And it shows you which ones you own. Any questions on that? Okay. I got all sorts of new charts up my sleeve. Total mortgage balances. This is what you wanted?
We've dubbed this chart the Sydney Opera House.
It does look good, right? I'm making art. It's very artistic. I went from like the four primary Nomad colors to rainbows, and you're liking this stuff, I bet, right? It's good stuff. All right, so this is what's going on. This is your total mortgage balances if you did the 11 Nomads. You see you actually get your total mortgage balance, your total amount under total debt earlier It goes to here. This is the peak. But then these are taking on later. And because you're buying more and more expensive properties, it's actually pretty close. Not off by that much from when you buy properties with 20% down, which you would think your mortgage balance would be lower, versus buying them with 5% down, which you'd think your mortgage balance would be less, but you're getting them earlier here compared to here.
Yeah, 150 months sooner.
Yeah, it's pretty significant. Yep. And then this is if you adjust for inflation. So these are in today's dollars, what it looks like. And it's even more pronounced because these are worth more earlier on. Make sense? This is just the same chart, except it's inflation adjusted. This is the total mortgage payments of your rentals. So this takes into account your principal and interest payment of your mortgages. This shows you what it is for Nomad. At your peak, you're at like, I don't know, $22,500 a month. When you do the 20% down ones, your mortgage payments are actually higher than your mortgage payments are for Nomad. Pause for dramatic effect. Mortgage payments for 20% down are higher than your mortgage payment are for Nomad. Two reasons. Higher interest rate, and what else? You're buying them later, so they're more expensive properties. So you end up having a higher mortgage payment because you're getting more expensive properties much later, and you have those here. These ones, you got them earlier, you're buying less expensive properties, and your interest rate is much lower. Combine those two things, and it turns out you have a lower overall mortgage payment when you combine all of them together than you do for the 20% down ones. Does that surprise anyone? It surprises me every time I see it. Math's probably wrong. Okay. I'm going to teach them over here. This is the same chart adjusted for inflation. Nothing else to say about that. Any questions? Yes, Nick.
So you're saying that Nomad, you're buying those at one every year, right?
It turns out it's longer than one a year because you can't save up fast enough to do it.
But you're saying that on your other ones, you're 20% down, you're saying it's taking longer. What if you could buy one every year, 20% down?
Totally. If you have an extra amount that you're starting with, then we can go ahead and model those more head-to-head. Like if you're starting with $1 million and you have enough for a certain number of down payments, we can go ahead and set the scenarios to say, we're each starting with $1 million. Now I only have to wait the 12 months to buy Nomad. For the 20% down ones, we can even buy them faster than one a year. We can do one every 6 months or whatever it is you want to do. Or adjust how much income you have or how much you're saving such that you can buy the properties much more frequently and see how that impacts things. Because these are based just on that assumption that I set up to begin with. But you're right. If you're saving $5,000 a month and you could buy a 20% down payment, every 6 months or whatever it is, that's a lot faster. And so that may make a big difference in your thing. In fact, if you could buy the 20% downs faster than one a year, it's probably better than Nomad, right? Because you can't buy Nomad but once a year, except for some really unusual situations. So yeah, that's one of the great things about being able to model it in the software, because I can't go do every iteration in a class, right? I can only do big picture stuff. Okay. Does that answer your question? Okay, awesome. Oops. All right, here are total monthly rents. Again, you're acquiring the property sooner, so you get up to a much higher rent faster. This is each one of the rents being added together until you see there a little bit here. There is something interesting about this in that your monthly rents on the Nomad property seem to be a little bit higher than the monthly rents on the 20% down, and I have not thought about why that is yet. Because they should be very similar.
Interest rate?
But that shouldn't do rent, though. I don't know. I'll have to think about that. Total cash flow shows you the cash flow you're getting from the Nomad ones versus the cash flow you're getting from all your 20% down ones combined. Eventually, when all the properties are paid off and everything's there, they become very, very similar. But until then, you actually see more cash flow, better cash flow from Nomads because you're acquiring them earlier and you're getting them in your portfolio and paying down debt and all sorts of other stuff like that. So all that's happening there. Any question on total cash flow?
So you're going out to 720 months or something like that?
Yes, 60 years.
What's more realistic? Wouldn't 40 years or 30 years be more realistic? So wouldn't we want to be looking at the 40-year?
Kevin, how old are you? 24. So if we go out 60 years, are you going to be retired by then? Depends on your age, right? So this is the big thing. If you're a 40-year-old and you're trying to do fire, and we think that the improved healthcare and people are living longer, we need to plan for 60 years. If you're 65, 70 years old, and you only have a 30-year, 40-year time horizon, then yeah, 60 years seems crazy.
So where were you 40 years ago?
Yeah, exactly, right? So it depends on your time horizon as to what you want to use for that end date. I totally agree with you. But because there's people under 40 in here, I think 60 is a reasonable number. Okay, any other questions? Yeah,
Just to backtrack,
backtrack, go back a slide.
while you're wondering why the rents were higher,
Oh yeah, why are the rents higher?
would it be because you acquired the properties sooner, so then they have grow more with inflation?
I think I'm actually taking into account inflation on the properties before you buy them too. So I don't know why they're higher. I'd really have to think about that. It's possible it's a math error.
Weird, because the market, you can only get what you can get, right?
Yeah, and we can model in if we do Monte Carlo stuff. Oh, finally someone got sick of the slides. Yeah, I know. Vic. I'll see you later. Yeah, I don't know why they're different. I'd really have to think about that. You asked something different. Oh, we could do Monte Carlo simulations for rent declines. So if you're really doing this, you're going to kind of actually do this as an investment strategy, you should come in here and play around with not rents going up at 3% static. You should say some years it's going to go down, some years it's going to go up, and run like a whole bunch of Monte Carlo simulations to do that. And we covered that partially in the class, just not with this level of detail and the other stuff. So yes, that's what we should do. Any other questions? Sweet. All right, we already covered cash flow. Oh, this is cash flow. Same thing, different format. So this shows you the cash flow numbers for this. Remember before we told you it's about 15,000 for 11 nomads. It's about 15,000 for the 11, for the 10, 20% down rentals and the 1 nomad property that we live in. So same type of numbers, very similar spreads. Okay, because they get similar at the very end. Any questions on that? Okay. Total account balances. So this shows, don't drink my water, please. So here's like, no properties, 1, 2, whatever it is, keep growing, growing, growing. And then this is Nomad. So Nomad has a much higher account balance at the end because you've had a whole bunch of time accumulating additional rents and stuff like that because you acquired them much earlier.
I don't, go back.
It's the same chart. Do you want to see the chart?
The colors are different on the monitor. So like on this monitor, it actually looks like there's 2 colors there. That's why I couldn't tell.
Can you see that? Is that?
It makes it much clearer.
Okay, yeah. I do this to kind of give you a visual of like what's happened over time, but really it's this number that matters, right? So these are all the different 20% down scenarios. This is 10 rental properties with 20% down and the one you live in. And then this is Nomad with 11 properties, one where you live in, 10 rentals. So this is your bank account balance. It's significant. It's like $3.4 million more in inflation adjusted dollars. So that's like $3.4 million in today's dollars. So it's a pretty big deal. That's my understated thing because I love charts is the most whatever it is for tonight. All right, any questions on this? I was going to teach from this side of the room. I'm going to do that. Any questions on total account balances? Sweet. All right, here we go. This is your risk curve, the debt to net worth curve of buying 20% down properties with the 11 Nomad kind of like superimposed behind it. So this is your first property. No matter which plan we're doing, Nomad or 20% down, we always buy this property. It's the first owner-occupant property that we buy. However, when you do the next 20% down property, it's this one, which is really interesting because as far as like risk goes, it's relatively small additional risk, right? It jumps up. It's not nearly as big as when we bought our second Nomad property, which was over 750% total debt to net worth. This one is just over 250. So almost a third of the risk. And it's also much later. It's basically right between when we buy the third and fourth property as a Nomad. Okay? So you could see that. Then this one we wait a lot longer, and that's even less. That's probably 200%. Then this one's lower and 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 lower. So when we buy the last property, it's probably one of the lower things of risk. But what's interesting to me is with Nomad, when you buy your last property, your risk curve just continues to decline. You're not buying anymore. You're not taking on any more debt. And so it's actually less risky for you to have done Nomad after you bought your 1, 2, 3, 4, 5. After you bought your fifth 20% down property, it's less risky for you to be a Nomad than it is for you to continue to increase your risk every time you buy another property from this measure, this one perspective on risk, the debt to net worth perspective. I'm saying that it's less risky to have done Nomad after you bought 5 20% down properties because you are increasing your risk above where you would be with Nomad doing that. Now, the risk you take as a Nomad, much more significant, much higher, much earlier. Would you rather have it earlier, or would you rather have this later? Yeah, right? So Nomad is interesting because you get to take all your risk and front load it, and you take big risks earlier, and you take less risk as time goes on. Is this super interesting, the risk stuff? Yep. Yeah, crazy, right? So, yeah, question.
Is there a way in the software, in the financial planning app to, I guess not an app, but to calculate taking leverage out of properties where you've got equity?
Yes. There's a way to set up rules that say go ahead and do a cash out refinance of a property to be able to buy new properties. That's one thing you can do. Yeah. And I'm sure there's other rules coming. Any other questions about the risk stuff? Okay. Rent resiliency, same idea. And we talked about this already. Your rents got higher when you bought the 11 Nomad properties, so you have greater rent resiliency because you bought them earlier than you do with the 20% down properties you were buying. So from a rent resiliency, another perspective on measuring risk, how much can rents drop before they go negative, you actually see higher rent resiliency than you do when you buy 20% down properties. Any questions on that? Sweet. Net worth. All right, this shows you all the net worth. Really hard to see, as Brian pointed out, so let's just go ahead and jump. Oh, this is me. This is me not adding in the Nomad one. This is when I add in Nomad. Your net worth is significantly greater when you have Nomad than when you don't have Nomad. So here it is. Adjusted for inflation. 8.7 for buying 10 rentals, living in one as an owner-occupant with 20% down. $12 million when you do Nomad, and this is in inflation-adjusted dollars. So it's, what is that? $3 million and change better to have done Nomad? That's kind of significant, in my opinion. Goals, this shows you all the goals for all the properties. I don't think I have Nomad on here yet, but this shows you all the different ones with 20% down. Here's the zoomed in version, a lot of craziness going on here. This is no properties, this is 1, 2, 3, 4, 5, 6, 7, 8, 10. And then over here, this is the number of months. So owning none, 562, 1, 476, 2, 408, 372, 372, yeah, whatever that means, 350, 338, 336, 336, 336, 336, and then these two ones are 301. What are those?
20% down?
Yeah, this is, that's 10, and this is 9. Yeah. I don't think so. I think there's just some weirdness going on. Like, it's actually right, but there's some weird things that happen. But we can check it. I mean, what's great about the way we built this is you could look into any variable and see if it's as expected. So we can go and troubleshoot if we need to. But I think it's actually correct. Actually, let's look. Oh, you know what's happening? This is really interesting. So this is kind of clever. So the reason why I think that's happening is it peaks over the 100% line, and it counts, it triggers that it does it at that point when you have a new property you bring on that has no mortgage on it for the first month, and so when they peak over, they go lower. And so that's what's going on there. It measures the first time it goes over the 100% line. So there's
a reason you should take that out.
Maybe. Maybe.
Like my spreadsheet.
Your spreadsheet is by year. That's the problem. Anyway, so this is why these are probably closer to these 336 numbers. This happened because they were close enough where they peaked above it and then they went back down below it. So just realize that. Yeah, see, we solved it real time. I can do math in front of the room. Okay, so I'm at 10 minutes left in the hour. I'm going to stop here because I don't think I'm going to be able to get through this whole next section in 10 minutes. But I will field questions and we'll talk about anything you want to talk about related to this stuff. And then we will continue with this in section 2 or section 2 and 3, depending on how long it goes. So what questions do you have? Yeah, microphone, that'd be great. Anyone have any questions? Tam, would you please do mic? No one asked questions? Did I just blow everyone's mind? They're like, holy crap, James, you went through like 100 charts in like 2 hours.
Yeah, what slide are you on?
That's a great question.
115. 115 of 306. Oh, now I'm at the beginning again. Yeah, I'm at the beginning again.
That's okay.
Any questions? Yeah, yeah.
Okay, so what happens on the nomad properties when you're buying them and you're holding them and you're not living in them and you go to sell them? Are there capital gains on those that you have to worry about?
We're not selling any properties in this scenario.
Oh, sorry.
So there's no sales. You're buying properties and you're renting them. So if you did have a sale, though, you would have capital gains. And if you had rented the property and you did have some depreciation, you would also have depreciation recapture. And depreciation is amazing when you own the properties and you're renting them out. It's a real pain in the butt when you sell them because you end up paying a 25% depreciation recapture tax when you do it. So the government mandates you have to take it. You cannot opt out of taking depreciation. And then when you actually sell the property, you pay capital gains on the difference between the price you paid for the property and what you sell it for based on your tax bracket and everything else, and whether it's short-term or long-term. And then on the depreciation amount you actually took, you pay 25% of that depreciation as a tax. And so it's higher than your long-term cap gains, but you get this really good cash flow benefit if you're holding the properties long term. It penalizes you for selling the properties like that. Unless you do a 1031. If you do 1031, you can delay paying depreciation recapture and your capital gains taxes. And it's not like you get rid of them. You just push them along down the road. At some point in the future, you're going to have to pay those unless you die.
The
So.
values make up for the taxes. I got it.
Oh.
The values make up for the taxes.
The values?
When you sell the property, you're obviously making a lot more than the taxes you'll be paying.
Maybe. It depends, right? You could sell a property for a loss. So in those cases, no.
If
But
you're holding on to them, though, as long as we look at,
yeah.
then you're going to have gains.
Yes, in the model we've done, you have gains on them. But I mean, things happen, right? I mean, you can have dips in the market and things happen where you don't have long-term cap gains or whatever, and you end up doing that. In those cases, I mean, yeah, you can adjust your plan, do 1031 or whatever you need to do. Yeah. Any other questions? So was that helpful? Like, should I even teach section 2, the second half? Was it worthwhile?
If you like charts.
I like charts. I do like charts. That is definitely true. Yeah. So I'm like a third of the way through. So, yeah. Tammy told me it was going to be long. But I tried to go slow to make sure everyone understood, right? I mean, I could have just pounded through and did 300 charts in 2 hours, which would have been bad for you. Would have been really bad for you. Would have been good for me, but bad for you. Any final questions? Do you guys like that risk stuff? Should I do a whole class on the risk kind of analysis stuff? Yeah, I think that's a pretty fascinating side of this thing. So I think I'm going to do some more stuff with risk and modeling risk and optimizing to minimize risk. So I've got some ideas on how to do that and some other ways to measure risk. And there's probably going to be like a Williams trademark score to like combine multiple risk parameters into one single number, somewhere between 1 and 0, probably. That's my guess.
Would you say the older the property is, your rents start to plateau at some point? Or slow down? So if I took, so like in your model,
Yeah.
you would show, oh, right, sorry. In your chart, you didn't sell any, right? So
Yes.
First rental property that you bought, fast forward 30 years from now.
Yeah.
Would you say if your rents, essentially, because you've got an older home now, aren't necessarily keeping up with, say, a new build?
It's weird because I could see where if you have a poorly maintained property, you could expect to get lower rents over time. However, if you're maintaining your property normally, I could think of counterexamples where, you know, a 100-year-old property is still getting decent rents. I mean, like, and the rents are still going up. So I don't think it's an automatic. I think part of it is a maintenance type thing. And we are setting aside 10% for maintenance on all these properties. So yeah, there's probably exceptions to this, but overall, no.
The reason I ask is because if you rewind 30 years, look
Yeah.
at properties, that are 30 years old or 30 plus years old.
Yeah, like 1970s properties.
Right. They're, to me, I guess what I've seen is you're not necessarily getting what you get in rent versus like a new build, right? It's lower, it seems.
Sometimes I think you could overcome that with area too. I mean, you have a 40-year-old property in Old Town, you're getting more than we got with new builds. And so there's some weird exceptions to that. I'm not sure I would make that a universal rule. But if you're concerned about that, the plan is then you buy a property, hold it for 10 years or whatever it is, and then you sell it or 1031 exchange into 2 properties, and you reset all those return on equity curves to the very beginning, and you maximize it anyway. And then you optimize for getting higher rents, you optimize for lower maintenance because you don't have any roofs or new kitchen remodels or new furnaces or ACs because you're trying to buy things where they're before you're going to hit those cycles. And so I think you can game the system a little bit by trying to optimize for what you hold in your portfolio. The problem with that is a lot of times there are transaction costs with selling properties, unless you're doing lease option tenant buyer things, which is a good solution. But there are also loan costs going in, and not being able to, like, I've got some clients that have these amazing interest rates on their loans, and they're like, I'd love to sell this property, but I'm not giving away a 3.25% loan. And so now all of a sudden you kind of like got golden handcuffs with interest rates. And you're like, there's no way I'm selling this property. The interest rate's too good. If I go buy a property now, it's 5.375. And who wants to do that? And so there's some weird things that can happen. So yeah, I don't know how to answer that really, but. Any other questions? Stick around for the class after the class. Everyone go talk to Brian here for a minute. And thank you all for coming. I will see you next time for the class.